is I hope your summers are going well. And I know many of you are getting ready to teach courses or to take classes. So I hope that whole semester goes well as well for you. So today we will be talking about business lingo for scientists. The way this workshop came about, by request from one of the University of Maryland scientists who attended a investor pitch where regional companies were pitching investors for funding, and he turned to me and said, I don't understand anything, half of what is being said here. You need to teach me this business mumbo jumbo because I don't understand what any of this means. And so I created this workshop in an attempt to not necessarily go in depth in explaining each of these terms, but to just go over most of the terms that you might hear or see during an investor pitch when either you're watching one or if you are talking to an investor, whether you're talking to investors, bankers, and such, you would be expected to at least understand some of these concepts. Throughout the year, we hold additional workshops where many of these concepts will be explored in detail. So if you're interested in a particular subject, please watch for our workshops scheduled for September, October, December, and such. And you will be able to go into many of these concepts in detail. So today we will go through, it's sort of like, think of it as MBA in an hour. This is going to be really quickly, a lot of information. But again, this is more like a reference starting point. Feel free to ask questions. I will try to answer them. Again, I'm not going to be able to go in detail or in a lot of depth on these subjects, but I'll try to answer them best I can. You can ask the questions either through Q&A function that, as Wendy suggested, or at the end, you can raise your hand, we can unmute you and turn on your camera so you can ask the question in person. So why don't we begin? So we'll start with just general business concepts. Elevator pitch or one-liner. So one to two sentences description of what is the value proposition that your idea or your startup offers. It's not designed to explain in detail how your technology works or what does your company do. It's really designed to get investors' attention and for them to say, tell me more. Here's my card, I'd like to talk to you more. So it needs to be done in a way that grabs somebody's attention and wants them to ask for more details. Value proposition is a statement explaining why would your customers want to buy or use your product or service. And typically your value proposition is centered around why is your solution better, cheaper, or faster. Competitive advantage, why is your product or service better, cheaper, faster than other solutions currently on the market? One of the mistakes that some people make is they say, oh, there's no competition. Nobody else is doing what I do. There's always competition. So, and investors will, or other people will always not take you seriously if you say you have no competitors. Don't forget about there's direct competition and indirect competition. So every solution, every problem has some sort of solution. It's just that if yours is better, you should look at who else is solving this problem and how, and talk about why your solution is better. Proof of concept, there's a business proof of concept and technological proof of concept. So a business proof of concept, it's a process that proves or disproves product market fit. So for example, before you open a bakery, you rent space, you hire employees, you might want to start selling your baked goods at a farmer's market to see if there is demand for your products, and to do further research into what type of products are most demand, how much people would buy, and such. Or for example, a lot of software companies provide services as an in-person consultant before they invest money into creating software solutions. The various types of corporate structure, and we will have a workshop led by an attorney talking about these, but just very quickly, sole proprietorship is when the owner is personally liable and owner's assets may be used to pay the company's debts. Company's finances flow through owner's personal finances. Typically, it's a one-person type of operation where there's not a whole lot of money happens and there's not a whole lot of liability that people need to worry about. The next one is LLC, Limited Liability Corporation. I'm sure you have heard about this corporate structure. So the difference here is that the owner is not personally liable for debts, unless they, of course, sign a personal guarantee. However, company finances still flow through owner's personal finances. So if the LLC makes money, that income goes on your personal income tax return. If LLC loses money, then you can claim that as business loss on your personal income tax return. However, if there's a lawsuit, the lawsuit is usually against the LLC, not your personal assets. That's a good way to separate and protect yourself. Many startups start out as LLC because it's very easy and inexpensive to set up, and it's a good way to have a starting point. Corporation is further down the line. It's where both liability and personal finances are separate from the owners. Corporation is treated as a person. The benefit there is that when finances are becoming very complex, you don't want them commingled with your personal finances. You need to have separate entity, and corporation is a good way to do that. In many cases, when equity investors are coming in, they would want the startup to be converted from LLC into corporation. The downside of that is the double taxation issue. So if a corporation, the company makes money, the company pays income tax, and then after that, you take that money personally and you still have to pay income tax as a person on top of that. Now we'll talk about, and there are other legal types of companies, legal corporate structures, but we'll talk more about it in a separate workshop. Now we'll talk about different types of startups, different types of businesses. And just know that there's no right or wrong answer. It just depends on what the company is intended to do, what the owners or founders intend to do with this company. So a high growth startup, it's a newly formed company with a very scalable business model, positioned to acquire a large market share very quickly and to grow revenue to 5 million or more within the next 5 to 8 years or so, depending on the industry, of course. High growth startup is the type of company that's positioned either for acquisition by somebody else or an IPO. And these are the types of companies where private equity investors invest in. Lifestyle businesses are startups or companies with business models that are very difficult to scale, or types of businesses where you're not intending, you would like to create a business to run for the rest of your life, or you know, for a very long time. You're not necessarily intending to sell it. In that case, you're not going to be able to attract equity investors, which is fine. Some examples of lifestyle businesses are family-owned restaurants, spa salons, photo studios, small consulting firms. So you create this business for yourself, and you run it for a long time. Maybe you sell it at the end, but that's not the original intention. Organically grown company, it could be high growth startup as well. So it's business where financing growth, where business is financing their growth solely through its own revenues and not taking any outside financing. So to finance your growth, add additional capacity, you don't necessarily go to private equity investors and take their money, but you only use your revenues to finance that. Typically happens with lifestyle businesses. Sometimes it happens with high growth startups. Dyson is a great example of an organically grown company. They never took any outside funding. Now we'll talk about various business models. And again, there are many various types of business models. We'll talk about some of them here. We'll have a separate session on going on some of these items in more depth. So business model describes how your business plans to create and deliver product or service to customers or users. How does your business plan to finance its operations and generate profit? Or if it's a nonprofit, how does your business plan to finance its operations? Business model canvas is a tool, or one of the tools that some startups prefer to use to create their business model. So think about it. I like this tool because it's very simple, and it has 9 different sections that makes you think about various things of how your business is going to operate, and various resources, partners, and such that you need to think through. It's also a good way to brainstorm various business models to see what type of outcomes you would have depending on how you change some of the variables. There is an online app. It's not cheap, teaching you how to use it. There are multiple YouTube videos if you're interested. And it's also used by NSF I-Corps. We'll talk about different business models now. Again, this is just a subset of them, the ones that you probably heard of. So B2B, business to business. Your customers are other businesses. So for example, you are Boeing and you are producing airliners for airlines. Your WeWork, you are renting space to startups and such, or existing companies. B2C, business to consumer. Your customers are individual consumers. For example, Under Armour sells to consumers, Nestle sells food to consumers and such. Bigger businesses, such as Under Armour and Nestle, in this example, can have both B2B and B2C operations within one business. Subscription is a very popular business model that investors really like. Services or products are sold on a subscription basis. So for example, Wine of the Month Club, Hungry Harvest is another example. Adobe Creative Cloud, you have to pay monthly. A lot of the software these days is no longer sold as a download or on a disk. but rather it's a monthly subscription or yearly subscription. SaaS, you will hear SaaS, it stands for software as a service. It's a type of a subscription business, usually monthly or annual subscriptions. And as I said before, investors really like these businesses because once you have a customer subscribe, they typically forget to unsubscribe, or they usually stay on longer than they normally otherwise would. And you don't have to spend money on marketing to get these customers to come back to you, which is really important. Premium model, you offer basic service for free and then charge for additional features. A lot of the software companies are using it. One example, great example is LinkedIn. Lots of people are on LinkedIn and using it for free. However, if you would like additional services, you're asked to pay for LinkedIn Premium. And there are many software packages that are offered for free, but if you'd like additional features or you would like something else on top of that, then you pay. And it's a great way of creating a potential market pool. Direct sales representatives sell directly to consumers, and they avoid retail middlemen. Some of the famous examples are Avon, Tupperware, and Mary Kay. A platform or marketplace has become increasingly important and popular in the last, let's say, 5 to 10 years. Basically, you're offering an opportunity to others to use your platform to make or sell product or service. One of the great examples is Amazon.com. They started out as an online bookstore. Then they added additional products. And what they did after that, they basically opened that platform for other people to open up Amazon store on that platform. So once they built the infrastructure, they built warehouses, they built software, and it not only allowed them to use that strength and that infrastructure, it also allowed them to be able to offer a much higher variety of products and services sold on that platform. Google Play, Apple Developer, iTunes is another good example where you use the tools to create apps that are later then distributed on that platform. Razor blade model or loss leader model is another name for this model. You sell fixed part of the equipment at a cost or even at a loss and charge for recurrent supplies. Great examples are printers and ink. So printers are usually fairly inexpensive. However, printer ink is one of the most expensive liquids in the world, as we all know. I'm sure many of you have lab equipment in your lab spaces, and you have to keep paying for lab supplies and such. Game consoles are usually sold very inexpensively, but then you have to pay for games and such. Again, this is another model that investors like because once the customer has that fixed part or equipment in their home or in their office, in their lab, then they will keep coming back to buy this supply that they need to use that fixed equipment. Talk about customer discovery. Customer discovery, it's a process of creating a hypothesis of who your customers are, why, what are they willing to pay for your product, how much, how do they normally buy it, and then you would test your hypothesis through a series of potential customer interviews and meetings. In September, we will have a workshop talking about how to approach customer discovery. And University of Maryland also runs regional I-Corps program where you can spend 2 weeks learning how to do customer discovery and actually spend 2 weeks actually doing it. It's a great program. Customer segment, it's a group of customers who share a defined set of characteristics. Geographic location, for example, income, age, gender, hobbies, and such. And the more specific you can get in describing your customer segment, the better. Because that would give you a better understanding of, first of all, how many do you have? How do you reach them? How do you communicate with them and such? Product market fit is a very important concept. It means when you have a product market fit, it means that product or service satisfies a continuously strong demand in a defined market where customers are willing to pay enough to sustain a profitable and scalable business model. TAM, or total addressable market, and the key word here is addressable market. It's number of customers who have a need for your specific product or service who you can reasonably market and sell to. So for example, if you're opening a restaurant, even though the food that you serve could be enjoyed by people all around the country, your addressable market are only people within driving distance to your restaurant. So that's your addressable market. When we talk about industry, industry could be either fragmented or consolidated or concentrated. And the difference there is fragmented industry, it's usually young industry. There usually are many smaller companies competing in the same marketplace. Consolidated, concentrated, usually a more mature industry. As industry develops and matures, it becomes more consolidated. Few large companies competing, and usually any new successful company is acquired, and mergers and acquisition is a prevalent market acquisition strategy. One example would be grocery stores. You can see that grocery stores chains keep buying independent stores, or they keep buying each other, because that's the best way for them to acquire additional customers and market share. Building a Safeway next to Giant doesn't make sense because there's not enough customers in that area to serve or to satisfy that new store. However, if you acquire the store in that area, you will be able to tap into that market. When you look at industry analysis reports or market reports, you will see a term called CAGR. It stands for Compound Annual Growth Rate. And typically it's used to describe industry or company growth. Usually you want CAGR to be positive. So if you're doing industry analysis, if CAGR is positive, it usually is an indicator that that industry or that market is growing. If it's negative, then you might want to reconsider going into that industry or that market. Competitive landscape, we talked a little bit about it before. So it's direct and indirect competition. Description, who else is solving the same problem as your solution? What is their value propositions, differences, similarities, and where do you fit? Let's talk about sales. No company can exist without sales. So this is really important. So sales cycle, it's the length of time it typically takes to sell something to a customer. So for example, if I walk into a Starbucks, it takes the amount of time it takes to get a transaction for me to pay for coffee and get it. However, if you're trying to sell something to University of Maryland, you know that depending on the amount of money, If you're selling something over $5,000, over $25,000, you have to get through a lot of approval processes. You might need to get on their next year's budget. So sales cycle could be a very long, could take up to a year or two. So understanding how long would it take for you to sell your product or service to a prospective customer is really important in planning your financials and in planning on, how would you project your sales and for planning purposes. CLV stands for customer lifetime value. Basically means how much money will a typical customer spend at your business in their lifetime. And it's a really important measure. So for example, and many successful companies understand, so Starbucks knows how much a typical customer will spend in their lifetime. And it's important when you're looking at whether or not to go into a certain market, how many prospective customers are in that market, addressable, what is your addressable target market, and what is the CLV, and that will give you a better idea whether or not it's a good idea to place your restaurant in that location, for example, or to go into that industry or that business. Customer acquisition cost, it means marketing and promotion costs divided by number of paying customers. Basically, how much does it cost you to acquire one customer? So if you are doing a marketing campaign and you're spending $1,000 on that campaign and you are getting 10 customers out of that, it means that it costs you $100 to bring in a new customer. So their CLV needs to be higher than $100 to make sense. If it is lower, then you should revisit your model. Sales pipeline is a number of prospective paying customers times the dollar amount of prospective sales. And this is where understanding the sales cycle is really important. How long would it take you to close those sales? And you can also weight sales pipeline. Weighted sales pipeline means weighted by probability of closing the deal. MRR stands for monthly recurring revenue, amount of revenue generated by recurrent customers. So for example, if you have subscription service, how much money does your business bring from recurrent customers to those who you don't need to market to? Or if you're a restaurant frequented by customers you don't need to market to, basically how much revenue is generated from existing customers versus new customers. Conversion rate, number of customers who convert from trial or free to paid customers. So what is the conversion rate from trial software to paid software? Or for example, in case of freemium, how many customers typically convert from freemium to premium? Also really important. Customer churn, how many recurrent customers drop off in a given time period? And you always will have customer churn. Understanding that number is really important. CRM stands for customer relationship management. It could be operational and analytical. Operational means it's a system where you are recording actual interactions, custom interactions, and you have tools to facilitate that. And analytical, basically, it analyzes the results of customer interactions with your business. And then a lot of tools to do that. Now let's talk about money, something that results from sales or you need it to actually finance your operations as well. So burn rate typically refers to startup companies that don't necessarily generate revenues yet, and it means how much money is your startup spending per month, and really the reason it's called burn rate because it is used mostly in reference with startups that don't generate sales yet. Basically, how much money does your startup use up every month, or burning through, I guess, in building that product or service. Revenues or sales, it's number of products or services sold times actual price charged. Revenue streams, sources of revenue for your company. Companies could have several revenue streams. So for example, you could revenue stream from the sale of your hardware, and another revenue stream, you could also be selling consultant services to some of your customers. Or you could have B2B revenue stream or B2C revenue stream. Typically when investors at very early stages ask for financial projections, they typically like to see those in the form of EBIDTA. EBIDTA is an accounting term, and it stands for earnings before interest, depreciation, tax, and amortization. And the reason investors like to see this particular format, it shows potential earnings of a company regardless of its capital structure. And it's very easy to understand format. And I have an example here on the slide. It's basically revenues minus expenses. So how much revenues can you generate? How much would you need to spend to generate those revenues, and then the profit or loss at the end. So it's a really good way to understand, does this business model, does this startup have a potential? So variable costs, so your company will always have, usually will have variable costs and fixed costs. So variable costs are costs that change with the change in the amount of products or services produced. So if you're using materials to make something, that's variable cost. It's going to increase or decrease with the amount of products you produce. If you're using hourly labor, that's also variable cost. Fixed cost or overhead, costs that stay the same regardless of the amount of product or services produced. For example, rent will stay the same, any capital investment, purchase of large equipment, full-time salaries and such. COGS are cost of goods sold, variable costs plus variable labor attributed to product sold. Operating income is another very important number, a very important concept for investors, for both for big and small companies. Operating income gives investors an idea of the health of the core business, of the core operations of the company. So it's revenues minus cost of goods sold, minus full-time wages, and minus depreciation and amortization. So it shows you, does the core business operation bring money or not? Regardless of what else the company might be doing. They might be doing investments on the side, they might be doing something else on the side, and that information is not as relevant. Profit margin is basically revenue minus cost of goods sold. Every industry has their own standard healthy range of profit margins. Usually, software as a service has very high profit margins simply because the variable costs are very basically non-existent. but operations like grocery stores, restaurants, very slim profit margins. So you need to be able to operate at scale to be able to make money for those. Sunk cost is a very important but difficult concept for people to deal with. So it's investment or cost that cannot be recovered. And what is the most difficult part is that sunk cost should never be considered in making decisions about future strategy, which is really difficult. So if you made big capital, you just bought a big piece of fixed equipment, you spent a lot of money into it, on it, but it turns out that for your future strategy, it doesn't make sense to use this equipment. You should consider it as a sunk cost and write it off somehow. It's really difficult. One of the good examples is Kodak as a company. As you know, they were mostly producing camera film. And when the digital photography came about and became popular, they had to make a decision on how could they readjust to that new reality. And they made the decision since their operations were built around producing film, then they should keep producing film because that's what they're built to do. And so they made that decision, and they ultimately had to go out of business because it didn't work for them. So this is where sunk cost got in the way of making a good decision about future strategy. Now let's talk about investments and outside funding. So you probably all heard, I'm sure you have, about VCs or venture capitalists and angel investors. So these groups of people invest in very early stage startups. They invest cash in return for equity, which is equity is shares of a company. So they both invest cash in return for equity in hopes of very high returns. The difference between VCs and angel investors is that angel investors invest their own money. Typically, angel investors are cashed out entrepreneurs who have had prior entrepreneurship startup success. They set aside a portion of the success money pool to basically to invest in other startups. Because they invest their own money, their risk profile is different. They are able to invest earlier because they are willing to take higher risks. But because they invest personal money, they also tend to invest lower amounts. Venture capitalists invest somebody else's money. And because of that, they have lower risk tolerance. So they invest in slightly further down the line when the startup is less risky. And they typically invest more money. And they typically take a seat on the board and other controls of the company. There's several investment stages. You all heard about pre-seed, seed. Typically those pre-seed and seed, that's where angel investors usually come in. And then VCs come in at Series A, B, mezzanine, and such. Dilution, when a company issues additional shares to new shareholders, such as VCs, angel investors, or new key employees, these additional company shares reduce percentage of a company attributed to each share, which could be good, could not be necessarily good. And non-dilutive funding that does not require equity in return. For example, SBIR grants, they're just grants, they go to the company and no equity is expected from the government. So there's dilutive and non-dilutive funding, and both have pros and cons. We do have a great workshop taught by our venture capitalist, Stan Smith, and he explains it really, really well. So I recommend that you tune into that workshop. When you negotiate in investments, you typically discuss valuation of your company. So there's pre-money valuation and post-money valuation. It basically means how much is your startup worth? And it's there's a lot of science behind it, but there are lots of rules of thumb for each industry at each stage, and there are and it's also art. And what this really means, so for example, investor offers to invest $1 million into your company for 25% equity. What it means that the company is worth $3 million pre-money and $4 million post-money if the deal gets done. Convertible debt note, it's a very popular startup financing mechanism for very early stage startups because it allows you to avoid calculating valuation at a very early stage when it would be really difficult to do so. Convertible debt note typically will convert into equity during the next round of financing, either at the same terms as negotiated by investors during that round, and typically there's a pre-negotiated discount. Safe note, it's a variation of convertible debt note, but it's basically stands for simple agreement for future equity. It's a variation of convertible debt note, but it actually never converts into debt. It is what it is. It's simple agreement for future equity. It never converts into debt, and it's easier to negotiate than convertible debt note. And it's becoming increasingly popular with startups. So whenever if you are building a high growth startup, you should always be thinking about the exit strategy, because that's how investors get paid. Basically, it means which large or established company will want to buy your startup in many cases, or is an IPO a reality in this industry. So investors who put money into equity, who put cash into equity, do not get paid until there's an exit event. And that's why this is really important. Use of funds. So if you're asking for money for investment, it's really important to talk about how much money you're asking and how will you spend it. Cap table stands for capitalization table. It's a table showing individual owners of the company with percentages and type of equity. Equity pool, company shares reserved for future key hires. So it's usually for high growth strategy. In your cap table, you will have equity pool. And term sheet is investment deal proposed by investors. And again, we will have a separate workshop talking about all of this in more detail sometime in the fall. Now let's talk about terms that relate to technology. So I'm sure you're all very familiar with TRL levels, technology readiness levels. It's a measure of maturity of a technology. I'm sure you're all very familiar with it. So proof of concept in the world of technology, it means that demonstration of feasibility of an idea, showing that your idea can actually work, showing that your invention actually can work. MVP stands for minimum viable product. It's a version of your product design that can work as a real product. Could be beta, could be even alpha, but it's what is the minimum version of your product without any bells and whistles, without any additional features for which the customers would be willing to pay. So understanding what your MVP is really important. IP landscape stands for intellectual property landscape. Which patents, copyright, trademark, trade secrets owned by you own, and what is owned by your competitors? Do you have freedom to operate? If not, what is needed for that? So it's really important. And we have a series of workshops on intellectual property concepts that you could sign up and attend as well. Now let's talk about people. Typically, when investors make an investment in a company, number one consideration that they have is people. Technology is important, market is important, but number one consideration is they invest in people. So first come the founders. Well, the founder is the person who came up with the concept and legally formed the company. It could be several co-founders. Next comes management team or CXO team, C-suite. That's your CEO, Chief Executive Officer, Chief Technology Officer, Chief Science Officer, and such. Founders could be playing any of these roles, but not necessarily. It is also very typical in technology startups that scientist is the original CEO. As the company grows, the scientist would become a CTO and a different CEO would be hired. These roles could be fluid, but not necessarily. And then there are situations where the founder is just the founder, but they don't necessarily play any of the CXO roles in the company. They may be on the board of advisors, scientific advisors, they may be board of directors, but not necessarily a CXO team. Board of directors, a group of individuals who represent shareholders' interests. They establish policies for corporate management and oversight, and they're the ones who appoint and manage the CEO. So they can hire and fire the CEO, and they make strategic and other important decisions. So board of directors have fiduciary responsibility, and it's an important role to play. Board of advisors, it's a group of individuals selected by company's founder and or CXO team to provide advice. Usually, it's advisable that very early stage startups establish board of advisors. It provides you credibility, and it supplements knowledge and network. And it also, it's a good thing to have board of advisors first, and then as you grow, you would establish a board of directors further. And then investors, individuals or organizations who are financing your company's operations, either in return for equity or other form of compensation. Typically, when selecting investors, it's important to select the right investors, somebody who can bring not just cash, but also be very, very good in terms of, first of all, understanding your industry, being able to provide advice, possibly introduce you to customers or partners and such. And we also will have a separate workshop talking about different roles that people play within the company. When do you need a CEO? When do you need a CFO and such? And what roles do they play? So stay tuned for that workshop. So additional workshops are posted on this URL. They're constantly updating. Throughout the summer, we reduced the number of workshops that we offer to once a week. but starting in September, we will go back to our usual 2 times a week. And for now, they all will be offered virtually. When we are able to go back and do these workshops in person, we will still offer both in-person and virtual format most likely. So thank you very much for your attention today. Does anybody have any questions? I think. Yes, we will provide slides, and also this workshop is recorded and we will post it on our YouTube channel, Startup UMD YouTube channel. And by the way, that channel has some of the additional workshops that have already happened and have been recorded if you are interested. And I know it was a lot of information.
Sorry, Alla. At this time, I'd like to interject, and if anyone doesn't have any questions, I'm going to post a poll with a few questions regarding our webinar today. And thanks for participating.
So thank you so much for filling out the and thank you for the compliments. If anybody has any questions, please feel free to ask them. Or as I mentioned, a lot of these topics will be covered in workshops that will restart in September. And next week, we have a workshop. It's more of a Q&A format, basically on how to start a business. So if you're interested in that, please tune in.
Okay, at this time, since no one has any questions, I would like to thank the speaker for her time and sharing with us today. I've learned a lot. Hope you all did as well. Feel free to reach out to us if you have any questions. I'll look forward for our next webinar next week. Have a great day, everyone.
Thank you, Wendy.
You're welcome. Bye.